Today is Monday, June 23rd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMI's Senior Ag Analyst, Mark Bowman, ADMI's Senior Market Research Analyst, and JP Snyder, ADMI's Associate Economist. Starting with the grain markets this morning, Mark, 1 week from today, the USDA will release its quarterly stocks and acreage report. What are your expectations?
Yeah, historically, we have a tendency to see corn acres move higher from March to June. That's happened now the last 4 years, and since 2000, in those 25 years, we've seen acres increase 18 times while falling only 7 times. And beans, actually, acres have fallen now the last 4 years, and longer term is a little bit more balanced than what we've seen in corn. Since 2000, acres have slipped 13 times. They've increased 10 times while holding steady in 2 years. So I like the odds of the higher corn acres. I'm going with 95.7 million. That's up only 375,000 from the March intentions, but up a little bit nevertheless. In beans, my forecast is 83.2 million acres. That's down about 300,000 from March. And if we realize would be the lowest since 2019, making it more critical that we achieve trendline yields here this upcoming growing season here in the U.S. On the stock side, I've got June 1st stocks for corn at 4.655 billion. That's down nearly 7% from a year ago. In beans, I've got stocks at 966 million acres. That's just ever so slightly below last year, 970. And in wheat, the June 1st stocks, that does represent the final ending stocks for the 24-25 growing season. I've got stocks at 850 million bushels. That's up only 9 million from the current USDA forecast. And that's well above what we had a year ago at this time at only 696 million.
Mark, when it comes to the corn market specifically, where do you see corn prices finding support?
Yeah, corn just continues to shrug off good demand in tight global stocks as it focuses on the favorable U.S. weather and the likelihood that South American production is underestimated. The USDA held their production forecast for Brazil unchanged this past month or earlier in June to 130 million metric tons. I think largely due to some delays with the harvesting of their crop. That's because it went in a little bit later than usual. Some private forecasts are as high as 140 million metric tons, above their previous record crop at 137. That was just 2 years ago. So I think recent weakness now in the spreads as well would suggest that just really don't see very much of a chance here for a bullish surprise on the stocks data next week. July corn has made a new contract low here today, and it's the lowest level for the spot contract in 7 months. And really not a whole lot of support here on the charts until 399. That was the low from last October for the spot futures contract. Weather-wise, if we finish off the 25 growing season favorably, I think new crop December is going to challenge 380 by mid to late August. Forecast right now, we've still got about 2 to 3 more months of growing season to go through. But as we look forward now, the extended forecast look mostly favorable into early July in that kind of crucial pollination stage. Speculative traders, yes, they're building up a rather sizable short position. So I think we could see some price spikes along the way if we start to see a little bit more of a threatening forecast here as we move forward in the growing season.
Thank you, Mark. Mark Bowman, what ramifications do the U.S. military strike on Iran have for global oil supply?
So we saw a spike higher overnight on the wake of the bombing, with markets sold off immediately and was back inside Friday's range by midnight. And now it's just about unchanged on the day. We do have a reversal action setting up if we fall below Friday's low, but that's a big if. The market is awaiting the reaction that Iran will take to the strikes. And the big question is, will they attempt to block the Strait of Hormuz, which is the conduit between the Persian Gulf and the Arabian Sea? Some 20% of the world oil supply moves through the strait, but to block it would be considered probably a desperate move on Iran's part. Iran also ships oil through the strait, and they would risk losing revenue and also irritating some of their main trading partners in China, not to mention fellow OPEC members. The global oil market does have spare capacity. OPEC Plus has about 5.7 million barrels per day in excess, with mostly Saudi Arabia and United Arab Emirates having about 4.2 million. And they ship most of that through the Strait. There's some pipeline, but that's a limited, there's only a limited capacity. We've already had reports of at least 2 super tankers having turned around at the Strait following the strikes over the weekend. So there's a lot riding on what Iran does next.
We'll have to keep monitoring that situation. And Mark, looking at the cocoa market, what are the West African rains telling us about the cocoa market setup right now?
Okay, so West Africa does continue to see regular active rainfall, which at this point is viewed as beneficial for cocoa production, especially for the main crop harvest that begins in October. We're still in the mid-crop for 24-25, and supplies have been kind of dragging lately. And it's important that the region sees rain mixed or sunshine mixed with the rain to avoid tree diseases and crop diseases. So far, there have been very few reports of problems. The market action on Friday, when we gap lower, indicates that traders are believing conditions are improving. There have been a couple anecdotal reports about concerns about recently harvested mid-crop beans getting some mold because of the wet conditions, but the trade may be more focused on that upcoming main crop. And we still, World Weather Service says we could see rain across routine rainfall over the next week to 10 days, with all areas getting impacted at several times. And most rains light to moderate, but some few stronger thunderstorms. But I remind you people, we still need sun. We had severe problems a couple of years ago when there was too much rain and not enough sun. That was back in August of 2023, and that brought about black pod disease and swollen shoot disease. One critical for a current crop, but the swollen shoot could kill trees over the long run. Farmers now are positioned better, though, because they have more funds at hand to treat fertilizers and fungicides, which was a problem back then.
JP, what is the significance of today's preliminary purchasing manager surveys?
Today's preliminary purchasing managers index surveys are significant because they offer somewhat of a forward-looking early snapshot of economic activity in major economies, particularly in the US, Eurozone, and UK for June so far. PMIs tracked business conditions in manufacturing sectors, which together make up the bulk of economic activity. A reading above 50 indicates expansion, while a reading below 50 indicates contraction. Today's data will kind of help assess whether or not the global economy is continuing to recover after Trump's April 2nd tariffs, or if the economies are facing continued headwinds. The S&P Flash U.S. Purchasing Manager Survey for June showed that manufacturing activity in the U.S. expanded, with preliminary reading for June of 50.2, which was a step above last month's figure of, matched last month's figure of 52.0, and matched or was above estimates of 51.1. Services PMI also outperformed estimates with a reading of 53.1, topping estimates of 52.2, although it was a slight drawdown from last month's 53.7. Although not as well regarded as the ISM PMI data, the S&P figures will attract some attention among those wanting to take a bit of a pulse of the American economy. Composite figures out of the EU gave a reading of 50.2, which matched the previous month's figure, but was below estimates of 50.5. Showing that private sector activity in the euro area largely stabilized. Notably, German activity returned to expansion territory, while France saw a further contraction in activity. PMI data out of the UK beat expectations and showed a growth over May's reading. Composite PMI came in at 50.7 for June, which was a step above May's 50.3. Now, manufacturing PMI came in at 47.7, showing a contraction in activity. However, that did beat expectations of 46.9 and was higher than May's 46.4, signaling that manufacturing activity contracted less than forecasted, while services PMI edged out expectations with a reading of 51.3. Now, with rising tensions in the Middle East pushing oil prices higher and some quick improvements in future growth forecasts, the PMI data serves as a quick assessment as to whether April was kind of the peak gloom of business sentiment. But so far, the figures have pointed to businesses being more optimistic, but only time will tell when finalized figures for June are released, which will offer greater detail and accuracy of business decisions.
And JP, last week we had the Fed Reserve meeting. How about a quick review of the notable takeaways from last week?
Yeah, so the Fed's decision to hold rates steady was expected and really offered no surprises. But what investors were looking at was for updates to the Fed's summary of economic projections and the dot plot, which shows a consensus prediction of where interest rates will be. Now, the Fed forecasted GDP to grow 1.4% in 2025 and 1.6% in 2026, which are notable slowdowns from growth in previous years, as the effects of tariffs are likely to slow business activity. However, that will just take time to tell as the data is backwards looking. The Fed still maintains its prediction of 2 more rate cuts by the end of 2025, although that is data dependent. They did emphasize that it was a prediction of rate cuts and not a forecast. So we'll just have to wait and see what the Fed does. Now, markets are expecting the Fed to cut rates at the September meeting, although some people have been upping their bets on a July rate cut. In his presser after the meeting, Fed Chairman Jerome Powell noted that the labor market is remaining solid, with conditions being broadly balanced and in line with historical signs of a balanced labor market, which was a welcome sign to many, as worries over the condition of the labor market have risen in recent weeks over an uptick in jobless claims. Now, Powell also stated that longer-term inflation measures remain consistent with the Fed's goal, although notably he did emphasize that the inflationary effects of tariffs will likely be felt in the coming months, and that the Fed is unsure whether or not tariffs will result in a persistent increase in prices or a one-time increase in prices. Now, that has been a focal point of many debates around inflation from tariffs, as some advocates of tariffs have said that the price increases will only be temporary, while critics have stated that the effects will be longer lasting. In reality, only time will tell as the world awaits for the final decision on the level of tariffs trading partners the U.S. will face, and ultimately inflation expectations will be tied to that level of tariffs.
Thank you. Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.